What's driving markets? Welcome to Market Take. Each week, we'll bring you our insights on the latest market and economic trends that are impacting investments. I'm your host, Ben Powell, Chief Investment Strategist for the Middle East and Asia Pacific at the BlackRock Investment Institute. This week, we share why we don't think a weaker US dollar is a statement on US assets. The dollar's slide this year has spurred questions about its status as a global haven. We don't see any evidence supporting that narrative. We think the dollar has moved in step with its historic drivers, not broken with them. The dollar has pulled back sharply this year. This sparks concerns that perhaps US assets were losing favor globally, but we're not seeing much evidence to support that. The dollar stayed mostly flat since the summer, even as tensions around Fed independence grew, and it held steady against other developed market currencies. If the dollar's reserve status was truly under threat, we think it would have weakened against these other currencies. Instead, we think the pullback we're seeing now is in step with two historic drivers. The first driver, rate cut expectations. Our analysis shows that anticipated Fed rate cuts account for roughly half of the greenback's drop. A fall in interest rates typically wears down the dollar's yield carry advantage over peer developed market currencies. But on the flip side, it boosts US equities. The second driver, the steepening of the yield curve as global debt concerns come to the fore. For years, investors flocked to long-term government bonds for their perceived stability. This kept the term premium, or the compensation investors demand for the risk of holding government debt long-term, below historic norms. Now, however, concerns about the cost of servicing ballooning government debt is bringing term premium back to more normal levels. These fiscal challenges aren't unique to the US. They're pushing up yields and weighing on developed market currencies across the board. That's why the US dollar hasn't weakened relative to these currencies. We think US stocks will continue to climb thanks to rate cuts and the artificial intelligence theme, but we look for more selective ideas as well. We like Spanish equities among developed markets. In emerging markets, we eye local currency debt and note that US dollar-based investors can get an extra boost when they convert back. We see gold and Bitcoin as potential portfolio diversifiers as long-term government bond yields rise in developed markets. Here's our market take. We attribute the dollar's decline this year to fiscal pressure and Fed rate cuts, not doubts about its reserve status. We stay overweight US stocks and eye opportunities in emerging markets. For details, read our weekly markets commentary. Go to www.blackrock.com/weekly-commentary. Thank you for tuning in. If you've enjoyed this episode, subscribe to Market Take wherever you get your podcasts.
Is intended for informational purposes only and does not constitute investment advice, a recommendation, or an offer or solicitation to purchase or sell any securities, funds, or strategies to any person in any jurisdiction in which an offer, solicitation, purchase, or sale would be unlawful under the securities laws of such jurisdiction. The opinions expressed are as of the date of publication and are subject to change without notice. Reliance upon information in this material is at the sole discretion of the listener. Investing involves risks. BlackRock does and may seek to do business with companies covered in this podcast. As a result, listeners should be aware that the firm may have a conflict of interest that could affect the objectivity of this podcast. For more information, visit blackrock.com/thebid.